When someone talks to you about investing, there are usually some innate resistance that will go like, I can't do it because I need a lot of money to even start investing, otherwise my gains do not see any returns. There is too much work involved, you gotta read up a lot of stuff. There's too much risk. But just before we close the ugly year of 2020, I put out a small little challenge, and the objective of this challenge is to see how much we will end up if we start investing with a small amount of money every single month. If you are new to the channel, thank you for stopping by, and if you have been a long time supporter, thank you so much for the support thus far. What will really help is if you can hit the like button down below. It will help the channel just a little bit. For many, investing seems like something that's unknown, scary, and sometimes some would even touch it with a 10-foot pole. So I thought to myself, why not run a social experiment with a small series dedicated to this cause? And that generated the idea of a small investor challenge. The idea is really simple. You can use whatever brokerage you're using. I'm using Tiger Brokers because the fees are low. You can get signed up with them with the links in the description down below. So with any broker that you're using, we'll buy $200 to $300 worth of stock or ETF every month. The hard part of this is being disciplined and buying every month consistently, regardless of price movement. This way, we'll increase our time in the market, which will ultimately build us some passive income. I know what you're thinking, we're like,
$200 to $300 a month, that will only give us a small amount of money invested in the market. Like, does it even make sense?
But personally for me, I've considered putting more money per month into the market, but to make things easy, I think $250 to $300 a month seems like an amount that won't break the bank or cause a huge disruption to anyone's lifestyle. And I kind of cheated a little bit because I tried it for the past 2 months since December, and I found out that it didn't affect my lifestyle much, and I still able to go out with friends, to go for drinks, to go and have makan and stuff like that. However, this number is just a guideline. Please feel free to adjust the number higher or lower depending on your income levels, expenditure, and saving habits. At the end of the day, the amount invested has to be constant because what we want to do here is to build a habit, and hopefully it will keep you invested for a long time. And to make things a little bit more exciting, I'll be showing my monthly stock purchases and tracking them month on month. Hopefully by the end of 2021, we'll have some interesting results. As always, do your due diligence before putting money into any type of investment or stocks mentioned in this video. So like I mentioned, I cheated a little bit because I started a bit earlier in December, but you know what? I've got to take some risks and put my money where my mouth is to show that this works before putting it out here on the internet. So the first stock that I bought when I started this challenge in December for myself was Genting, with the ticker G13. Basically what Genting does, in Singapore at least, is that they own RWS, which is Resort World Sentosa. So if you have no idea what Resort World Sentosa is, basically it's one of the biggest attractions in Singapore. When tourists come, it's a place that everybody goes to. Even for locals like myself, we do visit RWS once in a while because there's a lot of things to do there, like the aquarium. I recently went there earlier this year to play with some dolphins. And we have USS or Universal Studios, we have the casino, we have lots of food, we have a lot of shopping as well. But you must be wondering, are you crazy to buy tourism at this point of time right now? But just putting it out there, personally I feel that owning a little bit of Genting is a wise choice now because they're probably underperforming in the market. As long as borders are still closing, they are still going to underperform because there is no tourists coming in, or consumers might not have that much discretionary spending power. So at the point of recording, Genting is priced at like about 85 cents with a dividend rate of 2.9%, or they pay about 2.5 cents per dividend in 2020. I feel that there's a potential for them to put back those dividends when the border opens again and when we can travel. So in the last few months, Singapore actually opened up to phase 3, and what this means is that hotels, restaurants are able to take in more patrons. Attractions are also able to increase their operation capacity from 50% to 65%. So this definitely means that there will be more people able to go into the theme parks, into the dolphin park to enjoy themselves and to spend some money. So when they spend money right down there, that is where Genting earn most of their money as well. So Genting business is split into 2 different verticals. You have the gaming and you have the non-gaming. Gaming being the casino, which brought in about $1.6 billion, and the non-gaming segment of the business brought in another $860 million, giving Genting a revenue of $2.4 billion in 2019 and $2.5 billion in 2018. Definitely we won't be seeing great profits for 2020 due to, you know what, so like they say, buy when people are fearful and sell when people are greedy. The next stock that I bought right after Genting was STI ETF with the ticker ES3. So in the previous video, I shared a bit about what STI ETF does. Basically, it tracks the Straits Times Index. If you want to see an in-depth video, I'll put it in the cards above. So just a quick recap, an ETF is a basket of stocks. So if you think of the restaurant as the stock market, the different dishes as stock, an ETF is like a platter or a combo meal or a tasting plate, if you will. So the benefits of an ETF is that it costs a small amount of money, but you're able to get a little bit of everything that's available in the market. So under STI ETF, it tracks the Straits Times Index, and you're able to see the different components here. You have DBS, you have some of the telecoms, bigger REITs, all packed into one ETF itself. So the STI ETF consists of the top 30 performing companies in Singapore. And if you are local and you stay in Singapore, chances are you will more or less know the situation that's happening around you. And what I really like about this ETF is the dividend yield. With an average dividend yield of 3.5 to 4% in the last 3 years, this gives us quite a good amount of passive income.
Yes! Yes! Yes!
Though it might not be much in the beginning, but this will slowly build up over time. And at the time of recording, the price of STI ETF is below $3 and it pays an annual dividend of 12 cents, which gives us a yield of about 4%, which is pretty high. So on average, what I would like to look for in terms of dividend is a steady distribution of about 3.5 to 4%. With this dividend yield, it helps to beat inflation and also gives an extra yield for future investment. But as inflation continues to rise, we'll need to find different instruments to generate more wealth for our loved ones and ourselves. So by the time this video is published on the first day of February, it's time to buy a new stock as well. And the stock in question today is Keppel DC REIT. As the name suggests, it's a data center REIT. And according to the fact sheet, they invest in real estate that produces income through data center use purposes. So Keppel DC REIT has a ticker symbol AJBU on the SGX index. And if you use Tiger Brokers with the link down below, you get 5 free trade for US and Hong Kong stocks, and you'll enjoy a low trading fee of 0.08% per trade. Links are all in the description down below. So there are 3 types of data centers, and the first one is co-location data center. This means that the data center is leased out to multiple clients for short-term retail lease or longer-term wholesale lease to bigger clients. Next, we have the fully fitted data center. These are the data centers that are fully equipped and built for particular clients. So think of it as like a custom-built data center. And the last one is shell and core. These are similar to fully fitted data centers, but Keppel only owns the skeletal requirements. The mechanical and the electrical infrastructure is not provided by Keppel. So if you take a look at the breakdown of the lease by trade sectors, we have 47.5% in internet enterprises, 23% in telecommunications, 21% in IT services, 6% in financial services, and 1.8% in corporates. And if you break down the lease by type, you have 72% in co-location, 17% in fully fitted, and 10% in shell and core. So personally for me, when you're looking to buy a REIT, I think the most important thing that I look out for is whether they have long-standing contracts with their current clients, or do they have anchor clients that's going to rent with them for a long time. And for occupancy, I think you have to look for something that's at least above 90-95%. So with Keppel DC, they're at a 96% occupancy rate, which I think is pretty good. And on average, they have a pretty long WALE, which is WALE, which means weighted average lease expiry, and their WALE is 7.4 years, which means that they will continue getting rental from these companies for the next 7.4 years. Something that you might want to take note of is that with Keppel DC REITs, they do have other geographical locations like Australia, Ireland, UK, Germany, Netherlands, Italy, as well as Malaysia. And the main contributor to revenue is actually the Singapore region. However, Singapore being a land scarce city-state, we might not know how much more it can expand, because with REITs, you will need a bit more land. But on a closing note, Capo DC REIT got added into the Straits Times Index last October, replacing Capital Land Integrated Commercial Trust, which is like good news. At the end of the day, the goal I hope to achieve with this challenge is to reach a point where we can get dividends on a monthly basis, allowing us to reinvest those dividends on a monthly basis as well. And once we got a solid base of monthly income, we are able to take on a little bit more risk into growth stocks and etc. Nonetheless, some of you will prefer to invest in growth stocks and get a huge windfall before switching to dividend stocks. Ultimately, there's no right answer to this because everyone's lifestyle is different, my needs are different from yours, your wants are different from mine as well. But if you have any stock ideas, please share with me in the comments down below. Hit that like button if you have enjoyed this video, subscribe if you haven't, turn on the notifications so you get notified when a new video is up, and I'll see you in the next video. Bye.